So we are off the week of this reignited fear of software and the AI disruption, SaaSpocalypse, whatever you want to call it. When you look at some of the carnage, specifically in public markets, how much of it is just an issue of sentiment, a narrative that's gotten wrong, something wrong, or an actual fundamental issue with software?
Yeah, well, thank you. It's a great time to talk because we see so much opportunity in this new world of AI. We don't necessarily view SaaS and AI as different things. All of our software companies are using AI, they're selling AI, they're developing AI. And so we think the public markets, particularly for companies that have a certain set of attributes, and I can describe those attributes, but are not being very discerning. In other words, to think that all software is the same, we think is, they're missing the mark a bit. And so we love the way values are trending, especially in our space. And when we compare that to the performance of our companies, which is very strong, we think this could be a really exceptional buying opportunity.
So what are you looking for when you're looking at some of the carnage out there of what might be attractive to snap up?
Well, I think, look, the number one tenet of Thoma Bravo's investment thesis has always been quality of revenue, which means high renewal rates, lots of customers, things like that. Those types of companies tend to index very, very well in this new world of AI. And so when I think about the world of AI, we have kind of an internal AI opportunity framework, is what I would call it. And that has a lot to do with the depth of domain knowledge that a company has, that a software system has, the complexity of integrations with other software systems, the complexity of calculations that are required. Is it a transactional system of record that's helping an operator make a real-time decision with very low tolerance for error? Those kind of things index really high. And if you think of some of our companies, Dayforce with payroll, I mean, you can't make a payroll mistake. It's very complicated. It's highly regulated, different jurisdictions. If you're using Anaplan and you're a supply chain manager at LVMH and you have a manufacturing problem, you need to get this inventory into a new store tomorrow. Again, high cost of error. And so the list goes on, but or if you're Jeppesen with ForeFlight, aviation software, you know, you don't want United Airlines sending a pilot who's timed out to go fly a plane. Highly regulated, lots of calculations. And so these are the types of companies that we own. They're also the types of companies that are performing extremely well, and they're developing AI, and they're actually accelerating, not decelerating. So we think this narrative, and again, most software companies are actually private, not public. And so when we think of our portfolio, we think of this narrative, we think it's overwrought.
And I know you closed Dayforce last week, by the way, speaking of which, congratulations on that. I know we also first talked when you announced the deal, but that notably was a take private. I'm wondering where you're finding the value now. Is it in the public companies that have sold off, or in private markets? Are you seeing a lot of funds trying to unwind some of their software exposure that you'd be interested in picking up?
We're seeing both. And I mean, the public is obviously the first place to look. It reacts the quickest. It usually takes private valuations a bit longer to adjust, but there are people that are very risk off and they're trying to diversify out of software. And so those are opportunities, but also the public stocks, again, for the right types. One of the real benefits of being a sector specialist is we feel like we have a really good sense of what's working in this new world of AI, and we see it in our portfolio. And so we feel like we can discern what we should be buying and what we shouldn't be buying. So there's a lot of opportunity in the public markets as well.
There must be some threat somewhere, and I know you've written a bit about this. You wrote in the FT this idea that it's not going to be these AI startups that necessarily come and disrupt things, but it's going to come from the big foundational models, the OpenAI, the Anthropic. What are they able to disrupt?
Yeah, it's a great question. Look, these model companies are incredible at data science. They are not as great at understanding specific business processes in a large enterprise. And so we think, again, this combination of domain knowledge and AI, ultimately the winners. I described a set of characteristics earlier that we think really lends itself well in this new world of AI. So if you're going to say, what could they disrupt? Probably the opposite of those characteristics, which is, you know, maybe I'm sorting leads. It's a tool to sort leads for an inside sales rep, or it's a front-end marketing automation tool, or it's choosing words out of a document management. So there are several categories where they are probably less resilient, but on average, for the types of companies that we own, we see a lot more opportunity than risk.
I just want to be clear on this, because one of the narratives that's come out is this idea that you can have some person at a company who's vibe coding and is like, show me what Dayforce does, and I'm going to create a code that can do the same exact thing. This idea that someone can create something more cheaply within a company, what does that get wrong?
Oh, gosh. I mean, nobody is vibe coding Dayforce, okay? This is a super complex. At UPS, hundreds of thousands of employees are getting paid. They're hourly. They're checking in and out. We're doing the withholding tax for them all over the globe. I mean, that is not something you vibe code. It needs to be audited. It needs to be checked. It needs to be correct. It needs to be in real time. And I don't even think these companies have any aspiration of doing that. And frankly, even if I think about the domain knowledge, let's call it, say, Anaplan, another example. One thing we're not doing is sitting still, right? We have to be innovating. We're innovating fast. AI is helping us develop more applications quickly. But we think we have a real right to win. I think we see this agentic office of the CFO as the future of finance. And Anaplan, we think that's a combination of humans and agents and workers. And so we're marching fast. We have customers in beta that it's not easy to automate an enterprise business process. You have to really understand the data ontology. It's very complicated. And again, I go back to this real-time decision-making at scale, deterministic calculations. And so there's no vibe coding these mission-critical systems.
I do just wonder, because it's a large portfolio you have, over 75 portfolio companies. Are there any more maybe legacy software that you have bought, that you bought with not fully foreseeing what's happening with AI, and you need to change and you need to adjust? Have there been any disruptions in your portfolio companies, and how are you dealing with that if so?
We haven't seen that yet, to be honest. Like I said, I'm on 10 boards, and they all just had exceptional Q4s, and they all exceeded their forecast. I'd be dishonest to sit here and say that every company we have indexes as well as, but 95% of our companies do index really well in this world of AI, because we start with quality of revenue, right? When you buy a company that's got 97% renewal rates, high customer satisfaction, it tells you a lot about the company. It's a deeply embedded business process. It knows its domain very well. It's accumulated in the case of Jeppesen, over 100 years of helping airlines fly planes. I mean, there's a lot of accumulated domain knowledge, bug fixes, all these things. And so on average, we're seeing a lot more opportunity, and it's actually showing up in our results. We're selling AI, we're growing faster, we're accelerating. So in general, when you start with that quality of revenue, I think it indexes pretty well in this new world.
I hate every question that I'm asking is a downer, so stick with me here, because it just feels that there's just a lot of skepticism. And I know one of them that you've addressed head on, specifically on LinkedIn, is this idea that maybe companies are still going to have enterprise software, but they're just going to be spending less on it because they're spending more and more budgets are going towards AI. What do you think of that narrative?
Yeah, look, these are all legitimate debates to have. I sit on all these boards in our companies too. I mean, our CEOs are saying AI, AI, AI. Again, that's why I don't think there's this clear line between AI and software. AI is software. Software is AI if you do it right. And so, again, I would just go point to our recent results, right? I sat in 5 board meetings 2 weeks ago after big ends of the year, and the median bookings growth rate year over year, net new ARR added, was 22%, which is higher than the median revenue growth, which means those companies are accelerating. And AI is a part of the story. Like, they're selling 10 to 15% of the SKUs on average, probably in Q4, were AI SKUs. And companies are going on this journey with us because we have the domain and we understand how their data works.
Does pricing change at all? Do margins come under pressure?
Pricing is something that, look, I've never felt, by the way, that seats are a great proxy for pricing. Like, we sell software in a way so that companies can eliminate seats, but it's a convenient currency. We started to pivot away from that towards value-based pricing. I think seats will never go away, and frankly, I think the fear of seats going away is a little overblown. I mean, companies are reinvesting, but we are selling more consumption-based AI today. And we're really trying to sell value. So that is a pivot, and that's something that's been underway, though, at our company for quite a while.
It's funny you say that, because it feels like every day there's some new press release about Anthropic, or maybe a smaller company puts out an insurance AI product that can replace something, or it's legal, or what have you. I don't know how much you've really gotten the chance to look through some of these things, but what do you make of just this like spat of announcements of companies as quickly as they can, it feels like, trying to put out AI products that can theoretically replace something?
Totally. Look, we're not immune to reading the headlines and saying, gosh, what's happening, right? And so there is this. And so that's why we always go back. And we just had our inaugural, despite how many years we've been doing this, our inaugural CEO summit. We had all our CEOs in Puerto Rico last week. And we went through it, and of course we all play with these tools over the weekends and say, and I think we keep coming back to the marriage of domain knowledge, understanding an enterprise business process for these companies that are 96, 97% renewal rate, where calculations have to be correct. That's just a really defensible moat. I don't even want to call it a moat because we're growing faster. We think there's a huge TAM expansion opportunity. Now, we can't be complacent. We have to be developing new AI SKUs. We're taking big customers along. In Anaplan's case, like, here's what the agentic office of the CFO is going to look like in 3 years. And we think, frankly, tools like Claude, which we're using in all of our companies, we are a great route to market for them because they don't understand these domains in the same way that we do, these enterprise business processes in the same way that we do. So we view them, we love these tools. We're AI first, but we view them as our company is a great route to market for them.
Are you about to get a call from Sam Altman? Do you only use Claude and none of the other models?
No, we actually internally we use ChatGPT.
Okay, he'll be happy to know that, I'm sure.
But Anthropic's making really good inroads in the enterprise, and our companies do love the tool. So
what about Gemini? Is that factoring in?
Gemini, I mean we play with them all.
Okay.
But I would say from our view, it does look like in the enterprise, we started with Claude's MCP embedded into all of our software tools. It's incredible, and they just keep coming in the enterprise. So they look right now like a very good partner in the enterprise.
I would love to just leave it on the CEO confidence, because you mentioned you just met with all of them last week in your summit. What is the read you got from your portfolio company CEOs? What does sentiment look like right now?
Well, thank you for I probably should have added that as a criteria, because one thing you can't do is be complacent and sit still. The world is moving fast. It's easier to develop software. It's easier to develop applications. We're taking advantage of that. Like Anaplan a year ago might have had 5 or 6 applications they sold. Now we sell 26. We have a roadmap to sell many more. So, and we have this huge vision to be the agentic office of the CFO and to really attack the labor spend. And Coupa's got that same vision for the office of procurement, because we understand these domains and these business processes well. But the sentiment was great. I mean, everybody, because the companies are performing really well. And rather than get distracted by the market, I think we all came away sort of buoyed and said, we don't know if this is like a 2-week or 1 month or 6 month or year kind of moment in time, but we have highly profitable, high-growing software companies that know their domains really well, that are well capitalized, that have a lot of debt capacity. Let's be really acquisitive. Let's take advantage of this moment. Let's not worry about what the market's saying. If we believe what we're saying and these guys have a lot of conviction and so do we, then we should take advantage of this moment.